Hello and welcome to the Grain Trading 101 presentation. My name is Patrick White, owner and founder of AA Commodities and Investments. I'm a commodities broker. I help people trade futures and options. I'm located in Spencer, Iowa, which is in the Midwest. And the goal today is to shorten the learning curve for trading grain futures for you. And I hope you enjoy it. So I'm going to go ahead and start off with a disclaimer here. Just remember that there's significant risk in trading futures and options, and past performance is not indicative of future results. Losses happen. Manage your risk. If I get across anything to you in this today, I hope that it's to manage your risk, manage your downside. So a little bit on my background here. I grew up on a corn and soybean farm near Spencer, Iowa. And hedging with futures and options was always a part of the farm growing up. In fact, I made my first trade. I was in 5th grade. I think I was 11 years old. I traded corn options, and back in those days, it was a little bit more exciting. The grain markets were a lot more volatile back then, and I ended up making about 3 or 4 trades before I ended up going bust. But trading those one-lot corn options really just started the fire within me to continue on. And it was always kind of in the back of my head growing up that hey, futures trading is an option. Being a broker is an option as well. And so I decided to do both of those things. I attended and graduated from Iowa State University with a Bachelor of Science in Agricultural Business. While in college, I interned at INTL FC Stone, and I became a Series 3 licensed broker in 2015. FC Stone is a prominent clearinghouse in the industry. Since the spring of 2015, I've been studying price action, been studying indicators, and I did that only studying and writing notes in notebooks front and back, just filling them up for 2 years until I got my best strategy and traded gold in the summer of 2017 into 2018. I purchased a book of trading clients in Spencer, Iowa in 2018. I've basically been here trading and farming ever since. So I get to, I'm one of the lucky people. I get to do what I love, and that's trade commodities and farm corn and soybeans and a little bit of chickens. So going ahead, moving on here into what is a futures contract. So obviously you guys want to learn how to trade futures. A futures contract is an obligation to buy or sell a certain standardized commodity in the future at a certain price. So a certain standardized commodity would be like corn, number 2 yellow corn. They set up, certain grades for it. You can't have, so much foreign material. It can't be rotten. It's got to be a certain moisture. So it's all a standardized commodity. So when we're talking about it, we're not talking about, a different kind of commodity. We're not talking about, this guy's kind of corn. It's just all standardized. It's all standardized between corn, soybeans, wheat, cattle, hogs. It's all, up to a certain standard so that everything, it's just like the store, everything's the same. You go into a store and you buy something, it's going to be the same, today as it is tomorrow, and it's all standardized, it's all the same. Grain futures contracts trade in 5,000 bushel and 1,000 bushel increments. The 5,000 bushel contract is the regular contract. The 1,000 bushel contract is the mini contract. So there is an option to do it a little bit smaller. And obviously there's a really good break on margin there. Farmers use futures contracts to manage risk in the uncertain futures. So, when I'm a farmer, and my corn crop is out there, say we get a nice market rally and I want to protect my risk, well, I can sell a futures contract and that'll protect my price risk on my corn crop even before I harvest it. I don't have to have the physical corn in my possession, anything like that to make the trade. I can just go to the price ladder, sell the contract, and my price is locked in. Speculators, index funds, end users, and other people trade the other side of the farmer's trades. So when I'd be selling, other people would be buying, and they provide the liquidity for the agricultural industry. A lot of people, they're hung up on, speculators are evil. Well, there is a purpose to it. They do serve a purpose. There is, they do provide a lot of liquidity for the agricultural industry and make sure that there's another person to take that other end of your trade when you do want to manage your risk on your crop. There's a lot of futures contracts. There's corn, soybeans, soybean meal, soybean oil. There's wheat. There's 3 different kinds of wheat: soft wheat, hard wheat, Minneapolis wheat. There's oats, rice, cattle, feeder cattle, and lean hogs. Spreads are possible. So just like in stocks where you can buy Walmart and sell Costco, you can buy corn and sell wheat. It's kind of the same thing. I'm not going to go into that today, but just wanted to throw that out there that commodity spreads are possible. Or you can do another thing too, where you buy July corn and sell December corn, or vice versa, and do the same commodity, things like that, with a different expiration month. Benefits of futures, obviously farmers, the people that produce agricultural products, they benefit from futures. They can manage their risk and manage their downside there. And I think the futures are fair. For every buyer, there's a seller. Every time you buy a contract, there's somebody else on the other end of that sold it to you, and that other person guarantees the other side of the trade. Meaning that when when it goes your way and you make money, essentially you're taking money out of that other person's account, and they've got money in their account to guarantee that other side of the trade, guarantee that choice that they made. With futures, there's no time value or volatility going against you like in options. I can't even count how many times the market's been primed to rally, but those options are just right near expiration. With futures, you don't have that problem. It's just I think the market's going to go up or down, therefore I buy or sell, and there's nothing, no other expense, anything like that. With futures, there's leverage. This is one of the most important things about the futures market. Right now, for a contract of corn, it takes $990 in your account to trade that. But that 5,000 bushel contract of corn is totally worth $16,625. Okay, so you can control essentially $16,625 worth of assets for just $990 in your account. Talk about efficiency. That's 16.8 to 1 leverage. Now, why do they do that? Well, because commodities are supposed to have a base value. So, the likelihood of corn going to zero or negative like we saw in oil is extremely low. Not saying that it cannot happen, but with commodities, they're supposed to have a base value, meaning that it's probably not going to go to zero. If we did have a catastrophic event, it probably wouldn't take this whole $16,625. Most likely, it could, but and that's why your performance bond is so low. Obviously, the corn market is a low volatility market, and that factors into it as well here. And the last thing I've got are futures. It's simple. You're buying at one price, selling at another price. All you got to do is calculate the in-between and the commission, and that's it. So how grain futures work here, I'm going to dive in a little bit more. You've got to put up, for every contract that you trade, you've got to put up margin. And what margin is a performance bond to guarantee the other side of the trade. So if I buy corn at $3.30 and it goes to $3.20, I'm going to have that 10 cents, that $500 in my account to give to the other person that sold it as a performance bond to guarantee the other side of the trade. You've got to have the required margin in your account to trade. You've got to have the $990 in this case in corn, $16.50 for wheat, or $16.50 for soybeans, or $14.85 for wheat. And then there's the maintenance margins, which you have to keep in your account while you have the contracts open. So, if I have a contract of corn and I have $990 in my account and the market goes down and my account is less than $900, I'd have to meet a margin call here. Each penny move in grain is $50. That's going to save you guys a lot of grief. Every penny move is $50, and you can take, as far as like the option Greeks and stuff go to, you can multiply those, at least for theta and things like that, by $50. But yeah, every penny move is $50. Every 10 cents is $500 per contract. Every dollar is $5,000 per contract. And I've got a little bit of an example here for you. If we buy July corn at the Friday settlement at $3.22.5, and then on Monday it settles at $3.27, that'd be a 5.5 cent loss. And you take that 5.5 cents times the $50 for the 5,000 bushels, and that would be a $275 loss. And if you take that off your $990, that'd be $715 left, and you'd get a call from me that you'd be in a margin call. $715 is obviously, below 900, so you'd be a margin call. And you'd have to bring your account balance back up to that original 990, that original maintenance margin that it requires. So, and also another thing though too is that you have 3 days from that margin call to do that. So if the market comes back, you'd be off the hook, etc. I recommend to have at least double in margin what your max position size would require. So if you're going to trade up to 4 contracts of corn, I would recommend having $7,000 to $8,000, something like that in there, just to give yourself some buffer. Some people don't like to. Some people are comfortable transferring money in and out all the time. But just for me, just so you don't have to mess with it all the time. I think it's a lot less of a hassle just to have enough in your account to trade the products you're trading. If you don't, there's always the smaller contracts to go to. You can trade a combination of minis or micros or what have you to make it work for yourself. So, some factors facing ag futures market. I think number one, and this is a very important point, is that it's a futures market. We're not trading today. We're not trading yesterday. The future is always being traded. The market doesn't care that we've had a slide for the last 3 or 4 months. The future is the future. Okay. We're not. Yesterday the reports of the previous day, of the previous week, it's just not going to matter. The futures markets reflect right now on the screen where the price is. It reflects all of the information known from all the buyers and sellers. Everything out there that's affecting it. It's reflected in the price. So what you've got to do is you've got to ask yourself, what is changing? What is coming that could change the future? What are the expectations of buyers and sellers for the future? If we've got a report coming up and everyone's expecting that it's going to be bullish, we're probably going to rally into that report. And if the report comes out and it is bullish and we sell off, well, the expectation is that it was going to be really bullish, and that report wasn't bullish enough, and therefore people took it as a selling opportunity. Does that make sense? So, you got to ask yourself what's coming down the pipe, what's coming in the future that can change things. Right now, where we sit on June 20th, 2020, seasonality is huge. We've got a corn crop in the ground, we've got a soybean crop in the ground, and there's a lot of unknowns with weather. With whether or not North Dakota got their corn planted, whether or not the heat and dryness in Nebraska and South Dakota and North Dakota is going to affect things. Just a whole raft of things. So right now, weather is pretty much the driver. Weather and export demand from China really are the two huge drivers right now. And obviously those storylines are changing every day. So that's primarily, as far as from a fundamental reason, what we've got to watch out for going forward here. So other than that, I'm going to focus on my strategy in trading futures. And, what I do, I guess I break it down. I try and get a longer term outlook, and then I go on a shorter time frame and try and express that longer term outlook on that shorter time frame. And I found that I can have a little bit less risk on that lower time frame, and I can still let the longer term trend play out. I'm a trend follower. So I start with the weekly chart, and I use the 8-day exponential moving average. And why I use the exponential moving average is that it actually weights the closes of the last couple of days more than just the closes farther back. So it expresses the exponential moving average is better able to express what is happening currently with price right now faster than the simple moving average. So, and that's why I use it. It's just a little bit quicker. I like it. So when the price crosses above the 8-day EMA on the weekly continuous chart, that's my bullish or bearish filter. So when it crosses above there, I'm bullish. When it crosses below there, I'm bearish. And then I go ahead and I make my trade in 3 different units. You buy one contract after the first positive day on the daily chart. You buy another contract after the second positive day in the daily chart, and then you buy another 2 after a breakout of the swing high or a certain fixed amount, what have you. I'll show you an example here, but I do all my trades in 3 legs. Buy one more, buy 2 more, and then get out of the whole thing. And why I do this is because if you buy one and it goes against you, it's not the end of the world. You don't have all your 4 total contracts. If you buy 2, again, you're just increasing your odds of, if the market goes against you, if this thing goes awry, I do not want to be on the hook for my full position. And with that being said, as I make trades, as I make my position larger, I move my stop up and I keep my loss fixed. So as I buy one, buy a second one, buy 2 more, my stop is continuing to move higher and higher and higher. Less risk. So onto the charts here. I'm going to go ahead and start with an example in cotton, and then I'll bring it into the corn and soybean markets. So with the cotton market, this is the July 2020 cotton chart, and I'll show you on the weekly chart. So here's where 2020 started, right in here, and obviously we had a major sell-off, with COVID, Corona, whatever. We had a major sell-off into the $50 level, and we were oversold. This is a slow stochastic, just a regular, threw something up there. I like to use it as a reference. With that, we had a major sell-off. We were oversold on the stochastic. I figured we would eventually pop up and have a buying opportunity, and that's what happened. So On Friday, May 1st, we got our first weekly close above the 8 exponential moving average. And so that gave me the basis to be a long bias trader until we get a weekly close below this yellow line, this 8-day exponential moving average. So we dive into the daily chart here, and there is May 1st right there. I will make that a little bigger for you guys, but there's May 1st right there. Boom. At the close of this candle, you're bullish, okay? And on that first Monday and that Tuesday, we had both, down days. That's fine. The market's taking a breather. Look, we came from these lows at $48, and we went up and we made a pretty decent high at 57, well, 58 bucks, call it. I mean, that's a pretty decent sized move for the cotton market. It's going to take a breather. So we take a breather for these 3 days. Right here on May 6th, ended up entering on the close here, and I'm going to, for this example, I'm going to assume we didn't, obviously when we traded this, we didn't get exactly these prices, but if you assume that you get you buy at the close, the first entry would have been 54.51, and that is the close of this first candle here on May 6th. And you would buy one contract there, and you would look for confirmation on another candle with more upside, with more green, and you would enter two. So buy one at 54.51, buy two, or buy another one to have a total of two at 55.39, and that leaves you long two. And on this first one, I had a stop in on this whole position. I had a stop loss of $2,000. On the first one, the stop would have been at 50.51, and I'll just put a support and resistance line there. So there is stop one on this candle, and once you buy two, your stop to get $2,000 fixed loss would have been 52.59. It's not exactly, but anyway, so here's your stop down here. You're long from this close and this close. Your stop is down here. And then what I do is I use this swing high, either the swing high or the swing close as a pick, and I wait for a close above that. So as the market pushes up and as it rallies, I want to be bullish. I want to be more engaged in this. I want to let my profits run, and I want to have those profits increasingly, running increasingly higher. Anyways, so as on this day on May 12th, we got a close above this old swing high over here at 57.98 above the 58 level. So that was pretty bullish to me. And so we entered two more contracts up here at 58.34. And so that would have set our stop loss for the $2,000 fixed loss. We would have moved that up to 55.77, which is right there. There's 76. It's close enough. So let me just let the trade play out. We ended up targeting the $60 level even, and at that level, we got out of all four of those contracts at $6,460 in profit. For just for this example's sake, it was a little bit different when we did it. But anyways, the whole time, what I'm getting at is the whole time as you're buying, and then sell, your risk is limited. Your stop goes up, and up. And so your risk the whole time is fixed, and your profit is, somewhat unlimited until you get your target. So, as the market rallies, you want to continue to add increased risk, because you know what, if you're right, you might as well continue to bet more. You really, you need to have a higher reward in order to pay for the risks. I mean, you're just going to get stopped out a lot. It's going to happen, but as long as your profits, can make up for a lot of those losses at once, you've got a pretty darn good strategy, in my opinion. With this strategy, we had a 3.23 risk to reward ratio, which is pretty good. Over 3 in my book is pretty good. If you can get them over that, that's even better. For this trade at a 3.23 risk reward ratio, all you have to do is be right 31% of the time for it to break even. So if you're batting 40, 50%, I mean, geez, it's a pretty good strategy in my opinion there. So with that being said, that was just an example, and I can move it back out again. Yeah, we had the close above the 8-day right there at the end of May 1st there in the July cotton chart. And buy here, buy at this close, buy at this candle, and just let her rip. And we even could have gotten more too. That's the other thing. You could have let them trail. But regardless, okay. So the corn chart. where are we at right now in the corn chart? Well, if you look, obviously, kind of like cotton, we've had a heck of a sell-off here since 2020 began. We've gotten our first close above the 8 exponential moving average here at that was at 325 and a quarter. That happened on May 29th. So ever since May 29th in my newsletter and all my commentary on the radio, everything, I've been bullish. People, sometimes people don't necessarily believe it because it's a new uptrend starting, but whatever. Anyways, so there's the 29th there. We had a nice little breakout there on that Thursday. Friday took some profit taking, had a lower day. Boom, there's your first higher day. Go ahead and buy one. And then there's your your second consecutive higher day that's above where you got in initially, so you're adding to a winner on this day. And then you could either add to this breakout above here and above this high at basically 331 area, or if you're a more cautious trader, you could add above another area, say 339, 340, something like that. But basically, we've had a nice little bullish range here for the corn market. We've had support down here at 325, which was my support area in the newsletter. And if we break above this 335 level, I think we're probably headed up to higher prices. I guess my target for this one, I know July is coming off the board here soon, but my first target would be like 342, and then 355. And then 370, and those are just where the highs and lows stick out to me. We've got multiple areas of of buyers and sellers interacting that make those those levels pretty significant there. But with this here, I think we're starting, and just with the seasonality of things too. This is the time. This is prime time for the weather market. We don't know what's going to happen these next couple of weeks, whether it's going to stay hot and dry or whether we're going to get rain. It's all about buyers and sellers' expectations around what is that final yield going to be for corn and soybeans. How are we going to reflect that in the market? So if we continue to get dry weather, obviously this thing is going to rally. If we continue to get heat, we're probably going to rally. So what I would look for in the near term is sell-offs down to the 320s to be supported, and I would look for buyers to add to their long contracts here, 335 or higher here in July. And if you look at the soybean market as well, kind of a little bit of the same. I believe it was the same week. Oh, no, it was the week after. It was the week ending June 5th. That was a Friday. That's when we turned bullish there, and I'll make it a little bit bigger for you. If you notice, this week ending March 27th was also a bullish, bullish breakout. It was a trend change, but obviously the next week it didn't matter. So this, obviously this is not a 100% strategy, but anyways, this, the end of the June 5th week, I, changed it to bullish, changed the trend to bullish. And where is that? So there's June 5th right there. This little doji candle. We had a nice little rally there on that Thursday. Took profits Friday. So then we go into the week. Monday's bearish. Tuesday's bearish. Wednesday, get a nice little bit of a bump here. And this candle, it was up, but it really wasn't up that much. I would think you would buy here, and if you were looking to add a second one, this candle would probably be bullish enough for you. We were up 5.25 cents there. Obviously, you want to have your stops in the market here, and we did actually get a breakout and a close above this level. I would use this swing high as a pick here. That 873 and a quarter to 875 was 873 to 875. That was another level that I had in my newsletter as far as resistance goes. We broke above that, and we got a close here on Friday of 876 and a half. This would be my 1, 2, 4 contract long deal. I'm looking for this thing to run at least up to this 891 area, and that corresponds with these other highs over here. You can see obviously there was a lot of sellers up there. Look at all those 1, 2, 3, 4 tails. So I'd look for a run to this 891 level. If we break above that, we'd probably be heading to this 920 area. So, and that's an area of interest that I'm looking for my farmer customers as well, for hedging that 890 to 920 area. So that's kind of the long and the short of it here. No trading pun intended there, but basically, avoiding catastrophe. The biggest thing that you can do is avoid catastrophe for your life in your account. So, benefits of being a broker. I've seen what works and what doesn't work for dozens and dozens of people, and the things that don't work, I just put a short list up here. Adding the losers, essentially adding the losing contracts. If you're buying or selling and you're down and you add to get a better average, I mean, that's essentially the opposite of what I just showed you. You're just going to make your problem just that much, that much worse. If you bought one and you're down $500, why double your problems? I don't understand that, but people do it. They fight the market, and denying reality, denying that, I bought corn and it went down. It can't go down. There's no way it can go down. Buy me another one. It's like, no, you're just making your problem that much bigger. Not honoring your stop, not honoring risk management. If you move your stop, I've done this. Okay, this is one of my biggest struggles when I first started out. Yeah, I used to move my stop. I used to just try and fight the market. Just no, it can't go there. It's going to stop me out and rally. Well, at the end of the day, over the long term, over the long haul, moving your stop is not a good idea. It's basically just a death sentence. Because then what are your risk reward parameters? You don't have any. If you move your stop, if you don't have a stop, first of all, if you don't have a stop, I mean, there's no risk reward parameters, and you're just basically letting the market do what it wants to you. And that's not a very good place to fight from, in my perspective. Being on margin call for the sake of being on margin call. Hey, I've got $20,000. Corn costs $1,000 a contract. Let's do 20 contracts right now, and then tomorrow we're on margin call. It's like, no, why? You don't have to have that much risk in your account. You don't have to take those kinds of risks. In my opinion, it would be better. Well, and if you are going to do that, you definitely need to have a stop in or something to protect you. I think that you should only max your account out to whatever one half of your account. Say you've got $10,000 in your account. I think you should only trade $5,000 in margin. That gives you the buffer to be wrong, and wrong a few times before you're right again to pay for those losing trades. Trading long only or short only is also a death sentence. Being a perma bull or a perma bear, I mean, to me that's just synonymous for idiot. I mean, any market, any line is going to deviate from a low price or a high price, at some point. I don't know how you can just be a perma bull or a perma bear the entire time. You need to use the technicals. Do not deny technicals. Use the technicals to your advantage. Let those long-term trends play out and use those shorter time frames to manage risk. And that's about all I got here for you guys. If you guys, and thanks for watching as well here. If you guys want to know more information, you can sign up for my daily market commentary. I'll send it out to you every day. You can sign up for that at aa-commodities.com/newsletter. You can find me on Twitter and Facebook at aacom73. And you can call me at 712-262-7606. That's my office line. Whether I'm here or not, if I'm not here and you need to make a trade, it'll go to Chicago. But other than that, you can text me. That's my personal cell phone number, 260-2387. If you want to talk in person but can't meet there, or just, because of COVID, whatever, we can go on Skype, etc. And we can meet in person too. If you're ever driving through Iowa or at the Chicago Traders Expo, I typically make it out there every year. Hopefully they have one coming up soon here, but the Chicago Traders Expo, we can meet out there as well. More than happy to teach people what I know, everything I know. I'll talk to you as long as you need to be talked to. So that's all I got. Thank you for watching, guys. Appreciate it.